Today we have Mike Mackintosh, president of Impact Financial. Mike is the owner and founder of Impact Financial and has been helping and enabling service providers to help financial institutions originate loans faster, more cost effectively, and without increased risk. Mike currently works closely with the majority of industry leading service providers, top 25 financial solution institutions, and investors to create and implement solutions that will drastically improve the borrower experience. So without further ado, I'll introduce Mike Mackintosh.
Thanks, Bryce. I appreciate you guys having me on this and appreciate MemberClose as a partner. Before I jump into the actual programs, insurance programs that we provide, I'd like to give a brief background just so you can get comfort with where this insurance comes from and how long it's been around. Impact actually was created by me to acquire a company called United Specialty Services that created these programs for the real estate lending industry in 1999. So this is not something that's new to the industry. It's not something that has not been tested through downturns that we all experienced in the late 2000s, but it's not only succeeded, but it's thrived in these industries and become the standard in home equity. Prior to Impact, I actually owned the largest title provider for home equity called American Title, sold that in 2016, right before I acquired USS. I think that's helpful because not only do we understand the insurance programs very well at Impact Financial and understand the issues that you deal with, that gave me about 12, 13 years of experience of supporting, working directly with lenders to understand what the title needs are and what the risk associated to make sure that when you're underwriting and originating a new transaction, that you can do so with confidence. We did about 60% of all home equity transactions, and actually we're a partner of MemberClose, providing title searches back when I used to own American Title. So with that background, I just wanted to, hopefully we'll make this pretty open. Bryce, if you want to go down to the next slide that you had, and I do not do slideshows very well, is the purpose of these programs is really to stand behind the accuracy of the title process in general. And when I say that, it's to make sure that you guys you can rely on the information that you're getting, but also the information that you can't control when originating a home equity transaction, and be confident that in the event of a financial loss due to that title process, that there is an A-rated, AM Best insurance company standing behind the accuracy of that title process. Now, what do I mean by title process? What does the coverage actually cover? And I know that there's people in this call, some that utilize these programs and some that don't. So there's really two main options. And I'll start at the one that's more widely used, especially in credit unions, which is what we call the, and I know it varies, but the EquiPro is what MemberClose brands it at, but we call it really a legal investing coverage. And when we say that, what we're talking about when I say title process is it's a legal investing report that you're getting through the platform, and you're relying on your own credit report that you obtain to determine lien position. And that's the accuracy of the report. You're relying on that information just like you would, assuming that you're getting information directly from the county that will impact your ability to foreclose or collateralize, put a lien against that collateral that you are lending money on. In addition to covering the accuracy of the title, the legal investing, we also recover the accurate and timely recordation of your deed of trust or whatever document you may be utilizing, and the gap period. So if there's borrower fraud within the transaction, then we can also make sure that you have that coverage, that if you're intending to be in second lien position, you end up in fifth position because a borrower goes out and takes out 3 different loans in a very short period of time, and you're unable to collect, then this insurance steps in place to cover that. So it really covers the entire title process and any issues that you may have related to that title in the event of a financial loss to your institution. In addition to that, I know we have some customers on MemberClose that utilize our property report. The coverage actually operates the exact same. It's just the information that you're relying on is different, or different sources, data sources that you're relying on in order to get the ownership the voluntary, involuntary liens, because on a property report, all of that information is coming to you from county records. That takes a little bit longer. It's typically more expensive, and it may create less efficiency just because there may be unrecorded or liens that have been satisfied but have not been unrecorded and released that can cause issues for you and the title provider to get you a clean title so you can move forward with your member or borrower. You typically do not have that issue with a credit report because of the instantaneous feedback loop that you guys have with them in reporting outstanding balances and liens. So those are the high levels. I'll just dive into the next slide that really lays out kind of that these programs are not for all transactions, but we try and be so broad with our eligible mortgage loans that basically the only requirements that you have to meet in order to make the transaction eligible, that it allows you to do what you're best at. We are not lenders. We're not underwriters when it comes to underwriting loans. And we want to give you the flexibility to do that, but also it has to meet certain requirements. For example, this is only made for second mortgage and home equity transactions. So that can be a HELOC, it can be first position, it can be third position, it can be second, whatever your underwriting guidelines are and you're willing and able to do, we support that. But it's not for a purchase transaction, and this coverage is not for typically a refi. And then loans not to exceed $750,000 in loan amount. So it's not for unlimited amounts, but you can use it up to $750,000, which from our experience is about 99.999% of home equity transactions are in that range. And obviously there's some pockets of the country that may be a little bit higher percentage, but if you look at national, the numbers that we look at, it's a very, very small percentage. You can't also, this is not a product for subprime. Some of you may be looking at this saying a 520 FICO does not really qualify as a high FICO score. The main purpose of that is not to say that we want a lot of business in that lower tier. It's to make sure that, let's say you have a spouse that may not qualify because they're at 580, but then you have a spouse at 780 or 800. We want to make sure that you have the ability to underwrite that transaction as a whole versus as a just having to get exceptions. We don't want to have the back and forth when we trust that you guys know how to do this. Bryce, can you go up one? I don't have those memorized off the top of my head. There you go. Also, loan to value, I think this is pretty straightforward. 100% max CLTV, which is pretty standard in the industry. We did see some people in 0809 try and go higher than that, and that didn't work out for any of us. So that's a hard stop on the 100%. And then you'll see that the loans must close within 60 calendar days. I had mentioned earlier as part of the title process that you have that gap period, the time from when you receive that research and you can see what is against that property and when your transaction is actually recorded. There could be things that are filed in that time frame. We can't have that be unlimited. And that's why we have that 60 calendar days of report in order to limit that, but still give you plenty of time to close. The other thing that I'd like to point out is, I referenced the gap between the search completion date and the recording date, or from the data report to when you close. We also understand that you may have a report that it was completed on June 7th or July 17th, but the effective date of that county is July 1. That's an additional gap period. If there was something reported in that period from July 1 to July 17th that's unknown because the county records are behind, then you would be covered for that. The next item is documents must be submitted for recordation within 15 calendar days of funding. Again, this is trying to limit the amount of time, but it's also only referencing what you have to do. You need to submit those for recordation. We also know there may be delays at your service provider if you do outsource that function. And then also at the county, it may sit for a little bit. That's all part of the gap coverage, but we need to make sure that you're submitting those in a timely manner versus just having them sit in a desk and building time where something could impact your lien position. Residential properties only, and only properties located in the United States. So it's pretty straightforward. A lot of the things on the next slide that we don't reference, that we exclude, are basically just double speaking. It's saying the same thing of what's eligible, where it's not, it has to be, we say it has to be a residential property, you can't use it on commercial property. We do define what a residential property is for the coverage, which is 5 units or more are not allowed for the coverage. Again, loan properties located outside of the United States, not allowed, which we reference that it has to be in the United States above. And this is not for purchase money transactions. So we need to make sure it's against a home that that borrower is living in and has been living in order for it to qualify for the program. So again, I know that was fast because I wanted to leave a lot of the time available for questions and even scenarios that you may, a lot of the calls I'm on with our policyholders are, okay, how would this be handled by the coverage? And it's usually those, 1 to 2% of the issues that pops in people's top of mind, because that's the ones that you're probably dealing with versus the ones that are very clean and easy. So with that, I don't know, Bryce, how you want to handle questions or open up the line just to anything I had on the overview, but also if there's specific scenarios that would give everybody a better idea of how the coverage functions.
No, absolutely, Mike. I would like to, open it up if there are specific questions, scenarios that want to be asked. Happy to, control the chat, as well as, we can unmute you if you raise your hand and ask that question.
And maybe while people are thinking about that, Bryce, is there anything specific that you consistently hear from the member closed clients about the coverage that maybe we can address for everybody, even if it's just, from one customer? I don't know if that would help kind of get it started.
I think the question I see is, it's known or unknown encumbrances, that precede the loan application process. So, you're looking at, scenarios or encumbrances that are known or unknown prior to that institution taking that application, through the gap process that you talked about, which is the application process, underwriting process through recording. So,
yep. And I would just say it's consistently, it's unknown, right? If you're aware of something, whether that's on the credit report, the borrower's application, or a property report, then those would be the issues that that's your responsibility to clear those and understand of what position you're going to be in. It's really covering those things that are unknown because of an error in the title process or some type of borrower fraud or in the recording process. I see we got one question.
And a great question, because I know it's been one. The question is can you talk about if there's an issue with a title defect after the loan closes? Would that be a coverable scenario?
I would say yes. I mean, I'd like to know specifically what that title defect is, but that's really what that gap coverage is for. Now, and I want to make sure that we also define closing, where it's really after the report or closing. If something happened after the recordation, where you are recorded, you're in anticipated lien position, and then something else is filed that in certain states where it can jump you, those would not be covered, just like they would be covered by title insurance. So it's really, I would say yes, because after that closing, you do have that period. Again, I think it's more than just closing, because it's really after you receive the report, that if there's a title defect that impacts whether it's ownership or your ability to get the lien position that you anticipated, then that would be a covered event if you have a loss. I will, I didn't say this earlier, it is a dual trigger program. So there has to be an error in the title process, but there also has to be a financial loss to your institution. Even if there's an error, as long as that loan is performing and you're getting paid back, you've not experienced a loss yet. You have to have an error in the process, and either it has to foreclose or go into default, and it's uneconomical to foreclose because of the wrong ownership information on illegal investing, or because you're in a position that is not going to receive any funds from a foreclosure. Then you need those two things to happen in order for there to be a valid claim. I don't know, Ann, if that answered your question.
Ann and I have discussed this and looked at, the scenario is the historical line of title ownership, and and that is being questioned within the court system about going through the list of titles, and there are inquiries into who has the rights in ownership in title, and if there's a defect in that title based on who it should be and how it was filed, what is the impact on the institution and its borrower?
Yeah, so I think Anna said we answered, but I do want to, based on that scenario that Bryce let, these searches are only going current owner back, and the coverage only goes current owner back. That's as far as being searched. That's all that we can cover in order not to be title insurance, which is monoline. So, but if we've had many, when I say many claims, our claims are pretty, and you would experience this as you use this, it's not high frequency, right? It's high severity. We don't have a ton of claims because there haven't been a lot of defaults, right? We had a lot more claims in 08, 09, 2010. But when you're thinking about what you're paying transactionally versus our average claim is about $92,000, it's high severity. But we have had claims related to ownership that have gone back where, let's say it's the current borrower owns that home, and we find out that actually it was passed down to him and his sister, and he fraudulently changed it where he excluded his sister and went and took out a home equity loan. That would be covered. But if it was something that happened in 1943 and the property's been passed down 7 times generationally, and the current owners only had it since 2013, it wouldn't go back that far. It would go back to the 2013 when the current owner took it, would be how the coverage functions.
I may also add that the uniqueness of the loan scenario is based on the specific information that can be inclusive of the entirety of a loan file. So, it impacts the borrower. Obviously, title defects, as in that scenario with Anna, is going to be, it's in the court system, and they're going to make a decision based on, who's claiming what the claim is, and how it was transferred, and then assuming would realign the title as such, and then looking at the impacts of that down the line. So
yep.
And I can fair to say until they make a decision, the institution's not going to know until that is settled in court, and then realigned in the manner that is judged.
And we've had that. I can think of at least 3 or 4 claims, situations like that have been valid and paid based on there was fraud in that process by someone in the family or in a trust or on the deed that should not have been able to take out a loan without others signing that transaction as vested holders.
Like if a loan period is extended, what is the process? So, legal investing or prop report, knowing that, time frames that can be, say they take an initial app. What is the process to just, refresh that period, so to speak?
Yep. So all you really have to do is get an update to that original report, whether that's the legal investing or a property report. You get you get an update that refreshes and it restarts the clock. So then you'd have the additional 60 days to drive that through to the end. And again, that's a lot. We try and make it broad enough where it will catch the vast majority of transactions where you're not incurring any costs associated with an update. But at the same time, we can't have unlimited gap from an insurance perspective.
Mike, can you talk a little bit about, I guess I've seen scenarios where, it's, your expected lien position, like you said, is, determined at time of application. The time machine goes forward. Unfortunately, it goes to default, if full title or deeper search is done at time of default, and, the institution finds out they're in 5th position. talk a little bit about how, what are the impacts and what's kind of the process to get them back into their expected, and then, what the process can be after that based on, that order.
Yeah, so the remedy section, and I think most people have seen the service agreement if you're a current customer of Member Close, but the service agreement tries to make it very straightforward, right? Just like those in these slides, we have the eligible loan guidelines. Those are in the service agreement because we want to make sure that we're addressing and everybody understands what they're getting on the front end versus at the time of a claim. But in the example that Bryce gave, we would basically go through and we would say, okay, fifth lien position, the conditions are that it has to foreclose or ineligible to foreclose or unable to foreclose due to you're in fifth lien position, right? There's $350,000 in liens against the property. The house is worth $200,000. There's no way for you to collect that outstanding balance. In that case, that'd be very easy for us to handle swiftly. And just to be clear, once you guys have a valid claim, or I'm sorry, a claim that you submit with the claim form, we have 30 days once you've submitted all the information that's listed in that service agreement that we need in order to evaluate the claim to pay it, or respond back saying, hey, we agree there was an error, but we still need this information to happen in order for us to determine the remedy. When we look at the remedies, it's either the actual financial loss, it's actually the error or the error that was made, or the original loan amount are the three options, and it's the lesser of. So the example I would give of, Bryce talked about if there's 5 liens on that or you're in fifth position, you anticipate to be in second position, most likely there was some type of fraud or there's judgments out there that have been handled or that are creating an issue in your ability to collect against that collateral. That's a very easy thing to handle. Once you submit that information, tell us the story and show us that, we would go through a third-party search provider to validate what you've received, just to make sure that on behalf of the insurance company, we're paying valid claims, and match that all up. And then we submit that. We do our write-up. So Impact Financial is the program administrator. So we control the process of claims, policy issuance, premium collection, everything. But we would send an email with a letter to the insurance company saying, okay, here are all the facts, here's the supporting documentation, and we've determined this is a valid claim, and that would be paid. I don't know if that answered your question, Bryce, or if you want to get into more details, because it's kind of hard without, hey, we missed a $7,500 tax lien, or there was shotgun fraud, and there's, we have a $150,000 HELOC that's supposed to be in second, and really there's 3 other $150,000 HELOCs in front of us because of borrower fraud. All of those would be kind of handled differently based on the remedy section of the service agreement and policy.
Yes, it's important to say is, if there is a first lien position that's known through a credit report or, primary, and, you're looking at the dollar value is, you may get back to your expected lien position, and, that may be the remedy, but there may not be funds to, the first may swallow up the entirety of it.
100%. It's, all or some or most. So we would back into that of, hey, what did you get through that process? And if you have an outstanding balance after that, then that would be the claimable amount when you're looking at the lesser of. Again, and the tax lien's a little unique, and it's the same as the title would be, or title insurance would be, or similar to title insurance. Probably same. I don't like to say same as title insurance because this is not title insurance. Is, let's say, like I said, the tax lien. So it's a $250,000 property. There's a $200,000 first, and you did a $50,000 second. That's the 100 combined loan to value, and there was a missed tax lien for $7,500. What the insurance would pay is that $7,500 tax lien, because that's the lesser of the remedies, the error, the actual financial loss, or original loan amount. What we see typically is not that, because typically a borrower will continue paying their loan, so you don't really see that as a claim that's paid out, because it doesn't negatively impact the lender most of the time, unless it's like hundreds of federal tax liens that could be significant. We'll see that play out. But if one of the things that we see immediate, And very quickly after a transactions originate, when I say quickly, probably 180 days, is that shotgun fraud. Someone goes out and takes out 3 or 4 liens in a short period of time. They make 1 or 2 payments, and then they disappear against all of those. And if you anticipated being in first or second and you're really in fourth or third, that's usually going to be a full payout. And we saw a lot of that in 2006, 7, 8, and we're starting to see more of that today. So it kind of goes in waves of, from a fraud perspective, what we're seeing, but it can vary.
Mike, how long has the program been, how long have they been around?
So the programs were created in 1999 by United Specialty Services. They've been around that long. American Title, my old business, I bought in 2004, and we became the main provider of searches with this coverage. After 2009, when there were some major hiccups by the title underwriters that had competing home equity products or programs, and they all blew up and did not pay claims, these programs became the standard since about 2009. So the last 15 years, if a lender is utilizing a coverage and not self-insuring and taking that risk on themselves, they're utilizing either our program or something very similar.
Do different states address, lien protection differently in any way?
No, because it's not governed at the state level. So it's a nationwide product because it's surplus lines and we're standing behind, just like I'm sure that all of you contractually require member close to have standard E&O. This is also like a standard E&O, but it goes beyond that because it provides, one, it's occurrence based. So it's life of loan coverage, unlike a typical E&O. That way, if anything ever happened to member close, you know that you have coverage on any transaction that was originated with one of their searches in our coverage. You also, one of the big differences is your typical E&O has an annual aggregate let's say it's $1 million or $5 million, where if you have hundreds of customer clients utilizing member close and there's significant, let's say an error that is creating issues on searches that create a lot of liability, that could be eaten up pretty quick based on the loan amounts that we see. This has no annual aggregate, so it's unlimited risk. If there is a claim, it will be paid by the insurance company. And then the third main differentiation is typically the policyholder will have a deductible. So you're also reliant not just on the insurance company, but also your service provider to be able to pony up in the event of significant amount of claims. We have 0 deductible. That's important, not just for member close, but American Title. Like, we worked with 3 of the top 5 lenders in the country for home equity. Like, we love you guys more than anybody else, but you're privately held, you're small compared to all of your competitors. And that's why we really, bought into this program. And I ended up buying the company that created it because it gives the ability for you to work with the provider that you want without adding any risk to your institution. And in every situation we see, 90% of the business we see is either a lender is self-insuring. And when I say that, they're relying on a property report from a local provider. And typically the max liability on that is the cost of the report. So if there's an error, they're not on the hook, right? They may have to pay you $100 or whatever the cost of the report is, but they don't have to pay you the max liability like this program does. So I consider that self-insurance. With this program, it's very minimal in cost compared to taking all that risk on for you. And then probably 10% of transactions, probably 5% of transactions are still using some form of title insurance. But this is historically, especially for home equity, the best possible and most cost-effective solution because it pays claims and is written better than a junior lien policy, and the cost is significantly less than a JLP or a full Alta policy for home equity. So that's why this has really become the standard in the industry for all size lenders.
If there are no other questions, I will give everybody back the time in the day. Appreciate, Mike, you being on the call. Appreciate your partnership, as well as all the institutions that are member close clients, and happy to answer any questions, provide information at any time.
Thank you for having me, and we appreciate the partnership.
Thank you very much.
All right.
Everybody have a nice day, and we will talk to you soon.